Welcome back. We're back with Greg Taylor. He's Chief Investment Officer at Purpose Investments. Longtime viewers will know that Greg follows the gold market very closely. And this has been quite a week, Greg, for the price of gold. It has touched new record high territory. It's trading right now, the April contract, at 2,943, almost 44 US dollars per ounce. And that is a give or take a few dollars. That's about $20 shy of the record high touched just earlier this week. What is pushing gold up so dramatically, Greg? And can the rally in gold continue?
Oh, I certainly think it can, and it looks like it's taking an aim at that 3,000 ounce level, which everyone seems to be getting excited about. And usually you get these round numbers and everyone focuses on them, and we'll see if we can hit it in the next week or two. But it does feel like this is a really good setup for gold. There's a lot of geopolitical issues. We know there's a lot of fear and uncertainty about what's going to happen with trade. And I think that's pushing people towards gold is back to the original insurance policy. And I think the really nice setup for gold is that this move in gold we've been seeing is happening in the face of a stronger U.S. dollar. Gold is priced in U.S. dollars, so normally when the U.S. dollar is going up, the price of gold goes down. But what we're seeing is gold hitting an all-time high with the U.S. dollar going up. And I think this is something that could be a nice setup because listening to other comments from President Trump and people in his administration to keep trade going, they want to lower the U.S. dollar. So I don't think he's a strong dollar person. He'd like to see the dollar go lower. And if he can succeed in doing that, that's a nice tailwind to get gold through this 3,000 and potentially much higher on the back of that.
So if you look at the recent quarterly results from TSX-traded gold producers, I've got the Kinross numbers in front of me right now. We will take a closer look at those numbers with an analyst later in this program. You know, a couple of the basic numbers that stick out. The cost of the cost to Kinross of producing an ounce of gold in the quarter, the so-called all-in sustaining cost, was $1,360 US dollars per ounce. Its average realized price, the price that it actually sold gold at, was very close to being double that. So it makes about $1,300 on every ounce of gold it sells. That's a pretty good setup for these companies.
It is, and I think this is something that investors should be paying attention to because the gold miners have really underperformed the price move in gold, the physical commodity, in the last little bit. And I think we're starting to see a catch up. The gold stocks have had a nice start to the year, and I think seeing some of these earnings come true is going to justify this, that these companies are actually starting to put some of this move in the gold commodity to the bottom line. And I think that's something that is going to start getting people back to the space. The sector has been notorious as one that's destroyed value. And I think a lot of investors basically just said, look, I just want to own the commodity. I don't want to go anywhere near the companies. But I think as companies start to become more disciplined, they can kind of follow the model that the energy stocks did about 5 to 10 years ago, where they started to become much more efficient, better operators, fix their balance sheets. And if the gold companies start to do that with the strong price of gold, we could start to see the gold stocks start to gain some attention again.
There is risk, however, in the gold mining stocks. In one form of risk is geopolitical risk. And you know the situation that Barrick Gold is facing in Mali. Yep. The government has essentially shut its mine down, has seized a certain amount of gold, and outrageously has actually detained 4 Barrick executives in Mali. What is your view on how investors should think about companies that are exposed and do business in risky jurisdictions? Now, Barrick is a big company and operates in many places around the world, including some of the most mining-friendly jurisdictions in the world, but it also operates in places like Mali, where it's got a big problem right now.
Yeah, absolutely. And that's a risk you've got to take into account when you're looking at these companies and trying to decide how you want to get your gold exposure. The other story, though, was the big highlight last year was with Cobre Panama being shut down and the Panama government pulling the permits. And that had a big effect on Franco Nevada, which was seen as one of the safer ways to play gold. So geopolitical risk is something that's out there. And I think that's why we're starting to see a fairly good outperformance in the companies that are operating in the safer jurisdictions. And Canada comes up as something that's really going to be looking well for a lot of metrics, because with this Canadian dollar going down, that's another benefit to the margin because costs are dropping. And the margins start to expand. So I think you're starting to see outperformance of the Canadian producers. So Agnico, Wesdome, these names are doing really well. And it's because you're a safe jurisdiction and you've got costs coming down with the dollar falling.
What's your view of investors using ETFs to invest in gold mining equities, buying a large group of gold miners and perhaps mitigating their risk that way?
Yeah, it's probably a good way to get a basket. So you don't have to wake up one morning and see that the company you're invested in has a geopolitical risk or has a mine problem. These mines are not easy to operate, and they do every now and then have issues. So a basket approach is probably going to be safer. You may not get the full bang for your buck and upside as having the one stock that either gets taken over or has great numbers. But a basket approach is a nice way to get exposure to the sector and to minimize single stock risk.
Okay, final question. What's your view of the juniors, the companies that are exploring and developing projects rather than producing?
Yeah, so I'm a big fan of the juniors right now because I think what we're starting to see is that as these seniors start to do better, as we're starting to see the share prices of the Kinrosses, the Barricks start to do better, they're going to start doing some acquisitions. And I think because we haven't seen much development in the sector or exploration in the last few years, the only way they can get these new projects to fill in their pipeline is through acquisitions and M&A. So I think the juniors are looking great. It's an area, again, that has been really off the radar for generalist investors for the last number of years. So I think looking at some juniors here and maybe a basket approach of juniors could be a nice setup as these seniors start to go to make some acquisitions.
Greg, it's always good to talk to you. Thanks a lot for spending some time with us today. Greg Taylor.